Good morning, everyone, and thank you very much for joining. This is the morning market review with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com. Today is Thursday, it's the 3rd of March 2022. Just going to bring up our high-risk investment warning. I've also pasted the link for tomorrow's live NFP trade. So if you would like to join us for that, just go to the link and click on that and register. If you have any trouble with that, just email me and I'll email you the link back. But we will be doing a NFP trade tomorrow. Hey Zanetta, good morning Anna, and thank you everyone for joining this morning. Just bringing up our market commentaries disclaimer. And our references, FXCM Markets Scope 2.0. I'll read off the CNBC.com morning note. I'm not sure we'll do trading view, but just in case, I want to keep that up on the references. And let's just go through the news that we need to know for today. And it starts with the heading: European markets head for mixed open amid Ukraine-Russia tensions. European stocks are expected to open in mixed territory on Thursday as tensions remain high over the Russia-Ukraine crisis. The mixed open for European stocks comes amid heightened fears for Ukraine's future, with more reports of explosions in the capital, Kyiv, overnight. Earlier this week, a huge column of Russian military vehicles was making its way towards the capital, prompting concerns that Russia would soon launch a large-scale attack on the city. Ukraine's second biggest city, Kharkiv, suffered heavy bombardment on Wednesday, while Kherson's mayor said Russian forces have seized control of the key port city in southern Ukraine. If confirmed, it marks a military victory for Russia. Russia's week-long invasion was denounced by the United Nations in a historic vote, and dozens of countries referred Moscow to be probed for potential war crimes. Shares in Asia Pacific were largely higher on Thursday, after US stocks bounced back on Wednesday, although US stock futures were modestly lower overnight. Oil prices, however, continued to move higher following a price surge in recent days. In the morning of Asia trading hours, international benchmark Brent crude futures surged 3.09% to $116 per barrel, after earlier reaching a high as after earlier rising as high as 118.22 per barrel. US crude futures also climbed 2.43 to $113.29. OPEC and its allies decided Wednesday to hold production steady despite the recent dramatic spikes in oil prices. Earnings come from Merck, Telecom Italia, Prudential, and Aviva. Data releases include the Eurozone unemployment rate and producer prices for January. All right, let's take a look and see if there is any sense to be made. And I think that we need to acknowledge that it's a very difficult market to read. In fact, before we get into the before we even get into the DAX analysis, and we'll look at a few other instruments, I'll bring up Bitcoin, not because we want to do a Bitcoin analysis, which we did yesterday in our crypto minute. I just want to point out, so if we go back to, let's see, let's put in some verticals here. Let's put in some verticals from here to round about here. Okay, so we've got about 6 months here of an overbought market, which eventually corrected in an extremely vicious way. So there was a 50% correction after this overbought condition. We're going back quite some time. And the point is, when there is an emotional commitment to markets, the oscillators can make little sense. And it brings me back to a quote, and I'm not sure if I'm going to quote this 100% correctly, but it was made by John Maynard Keynes, who's the effectively was the who started Keynesian economics, and he said the markets can remain irrational far longer than you can remain solvent. I'm not sure if I've got it 100% correct, but that was the gist of his quote. So if we go through to the markets at the moment, there is a tremendous amount of emotion that is inherent in the price action. When that emotion evaporates, is a huge question mark. Every day we're reading some news headlines that really sort of chill you to the bone. So there's certainly a sentiment that is running hot at the moment. All right, let's see what we can see here. So Peter makes a comment here. Reading this use of dollar sanctions could speed up the decline of fiat currency as other countries see what happens. Let me give that some thought. I'll try to respond again. No, it's a big question mark there. Anna's asking, is that why I'm staying out at the moment? Not necessarily, Anna. If there is some sort of opportunity, I would take it. I think there is I think there would be some sort of influence, perhaps that I'm not recognizing consciously, that's keeping me sort of on the sidelines. So I'm not sure if that's the I'm not sure if that answers. So I'm not consciously staying out, but maybe sort of on a subconscious level, I am. I'm not saying. Yeah. Pete says he's sitting on his hands. So the decline of fiat currency, I mean, I just don't see that happening. I don't see that happening because it largely makes it will largely make monetary policy mute, which is impossible to see. If anything, Pete, I think it would speed up the regulation of cryptos rather than see the decline of fiat. That's kind of where that's the side I'm sitting on. But again, I'm going to end off with subject to correction, because it's CBDCs are not cryptos. CBDCs are not cryptos. That may be the case. I'm not sure what a CBDC is, unfortunately. So if you just explain that to me, and I'll let the attendees know. Take the control from any central bank digital currencies. Oh, yes, those aren't. Central bank digital currencies are not cryptos because they are regulated by the central bank. So China's digital currency would not be comparable to Bitcoin. Yes, I would agree with that. But I'm not talking about. I would suggest that central bank digital currencies would still be fiat. That'd still be fiat. There's no. They're backed by a promise. You know. Whether the crypto market is regulated or not, I think for me, That is a very interesting question. Let me, before we get into the analysis of the DAX, I promise we'll get into it at the moment. Let me just bring up Paint here, Microsoft Paint. So we have discussed this previously, but I think it's worth just taking a look at it again. So you've got different phases of not a business, of an industry. So you would have, and again, I'm talking specifically about cryptos here, not digital dollars, not digital yuan. I think that's the same as, to me, that's exactly the same as fiat. But you would have the you'd have a sort of a startup phase or embryonic stage. You'd have here growth stage. You would have after growth something called shakeout stage. And then after shakeout, you'd have something called the mature phase. After mature, I'm just going to put this down over here. You're going to have something called the decline. And let's put this decline in. The x-axis is not according to scale, so I don't think we've got a small mature phase. That's not what I'm trying to. So I just didn't have space there. We probably mature would be a long phase, but you would kind of have something that goes like this, like that, okay, like this, and then you'd have something kind of like this. I haven't quite got it right, but it would be, yeah, be something like that. And then you've got to think, well, how is this going to apply to crypto? So I think cryptos are beyond startup. Okay, I think they're beyond growth, or they were beyond growth prior to the geopolitical escalation. They were at shakeout, so that's where I think they were. How long shakeout stage lasts? How long does the mature last? And you know, is there a decline? What I fear could happen is that there could be regulation, and the regulation cuts the and the regulation comes. This is, where does this model come from? It comes from CFA level 1, but I'm not sure who devised it. So the idea here is we could get some sort of regulation which cuts the mature, cuts the decline. I just don't see regulatory authorities gambling with monetary policy. I just don't see it. Cryptos play a huge burden of risk if you can't control your monetary policy. And the fact now that there is almost a loophole in sanctions, to me, seems to suggest, well, maybe we've got to tie this loose end up sooner rather than later. So I'm a little nervous around the crypto currency. The lack of regulation, okay, I think is a massive debate. Does somebody prefer an unregulated market to a regulated market? And what are the benefits versus the cons there? So I think that the idea here is we've got real risk that the shakeout stage gets cut exceptionally short, and I think there's a real risk of us running down. But that's speculation. It's speculation. So just be aware that this is sort of opinion, and it's not factual. But I think there is a serious discussion to be had around that. But I don't know quite where this model was derived from. It's a basic in the CFA curriculum, and I'm just trying to remember which part it comes from. It comes from the equity section, I believe. And the reason it comes from the equity selection is because in that section, it's talking about a top-down analysis. So you start off with the industry. You start off with, there's something called Porter's 5 forces. One of the forces there is industry competition. There's another word for it. I'm a little blank at the moment. But it's rivalry within the industry. And the question is, well, at which stage of the game is rivalry going to be the most intense? And it's around shakeout. So you kind of, when you do a top-down analysis on a fundamental basis, and you're looking at the industry before you're looking at the companies, you want to try and figure out which stage they're in. Typically, your NASDAQ companies would be here. That's the growth companies. Typically, your S&P 500 or your Dow Jones companies kind of be here. So when we're talking about growth companies, this is their stage. When we're talking about sort of your cyclical value, we're talking about mature. So that's kind of the way this model would work. Let me see if I've missed anything. So central bank digital. I think we're heading towards central bank digital currencies. That's not a deregulated market. The question is, of course, around the cryptos. Yes, so I would certainly agree with that, Anna. Pete says the dollar is controlled by US whims as a reserve, so it would be better if countries moved away from that. I don't see that happening either. I mean, there may be a case for other reserve currencies, but I think that's very much a sort of a stock standard part of the financial markets. I just don't see it changing, and I think that these geopolitical crises are probably entrenching that, Pete. Let's actually take a look at the DAX versus gold. And I'll tell you why this is a fairly good idea to take a look at this. It's because it's very difficult to be in my case, it's very difficult to be objective in a market where you've got this huge downtrend, because I tend to panic. That's the friction, or the tension is a better word. It's the tension between fear in the market and greed, and fear is the stronger emotion. So when I'm looking at the DAX, I panic. We've got a lower peak followed by a lower trough, and I'm thinking, good grief, where are we heading with the DAX? And the perhaps comparison to gold, which is moving up, hopefully makes it a little bit more objective for us. These charts are very similar, and the reason that they're similar, when I say similar, similar in terms of lower peak, lower trough for DAX, where we've got a higher trough, higher peak for gold. So in other words, the correlation here is almost completely at -1, right? They're moving in completely opposite directions. If you had a two instrument portfolio of gold and DAX, you're probably sitting pretty close to neutral, because any losses you've made on DAX, you've made up for in profits on gold. So, and Anna says, when have we hit the bottom to take advantage of the opportunity? And that's the question that we've got to try and answer. So I don't know where the downtrend ends, but I don't want to get caught in a panic where we think that we're in a perpetual downtrend. Okay, so in other words, if we get any bounce here, is it a dead cat bounce, which is the same suckers rally, right? Bear market rally, and do we get caught on the way down? So something to note, of course, is that gold is, let's perhaps just take these moving averages out, just so we get a better comparison. Gold has actually had an uncertain week, okay? And I think this is very important for us for the time being. It can evolve, it can change, but the analysis of gold is that we are uncertain. What I mean by uncertain is as follows. So I'm just trying to get my arrow here. There we go. We've got a inside period, okay, or an inside week until proven otherwise. You can see that gold has a lower high than last week, and it's got a higher low than last week. In other words, neither the bulls nor the bears have had the upper hand here to take price to new highs or to new lows. So we're kind of in an indecisive market. Not only do we have an inside period, okay, in gold, we've got a spinning top. So if we just take a look at this week's candle in isolation, you've got bulls that have tried to take price up, you've got bears that have tried to take price down, but we're kind of near flat for the week in terms of gold. So we've got a double sort of signal of indecisiveness. And the question we've got to ask is why? Okay, question we've got to ask is why? Why is gold showing signs of indecisiveness? Now, of course, it's not an easy question to answer. The other aspect to this analysis is that when we look at the stochastic is making its way into a very bullish area. In other words, this indecisiveness may be temporary before gold continues upwards. Now let's just talk about gold, and then we're going to make references back to the DAX. If we do get the gold stochastic hitting 80, and if we get it maintaining in that 80 area, then I think we see higher gold prices. And I think that could mean that there is a distinct appetite for the safe haven. And the reason that there would be an appetite for the safe haven is because geopolitical tensions are escalating to past past previous levels of fear. Money is rotating, it's going into gold just to protect value. It's a store of value. It would also suggest to me that we are getting to a stagflationary environment, which is, we've mentioned before, it's a terrible environment to be in for policymakers. There's not much you can do. The way that a stagflationary environment ends, the way that it ends with sort of the least amount of damage is if you do nothing. In other words, there is going to be damage to the economy regardless, but if you try and interfere with it, the damage is going to be even more severe. So, but policymakers can't be seen to be doing nothing. So they're stuck between a rock and a hard place. So stagflation is a terrible, terrible economic environment to be in. But we are getting to a point where there is a real possibility of that. And the reason for that is because of high input prices, most notably energy, oil. We are seeing wheat. I'm going to do an article on wheat later. Wheat has gone limit up 2 days in a row and at least 3 days over the last week. But for the last 2 days, it's gone limit up. What does limit up mean? In a futures market, you would have a close. You would have a close. And then I'm not sure exactly what the percentage is, but you would have a percentage up, giving you an upper limit, and you would have a percentage down, giving you a lower limit. And generally what happens in a normal functioning futures market is that a price wouldn't hit the upper limit and it wouldn't hit the lower limit, because that would be abnormal price movement. What's been happening in the wheat market is we've gone limit up 2 days in a row. In other words, we've hit the limit because of a fear that wheat supply is going to be disrupted. And there's a real possibility of that because Ukraine is a quarter of the world's exports of wheat. So the idea here is, and what does limit up means? Limit up means trading is halted. You can't trade higher than the limit up, and you can't trade lower than the limits below. In other words, if you want to trade wheat, you're going to have to trade within the bands. We've gone limit up 2 days in a row, and as I say, at least 3 times over the last week. And the reason for that is real concerns for wheat on the production side, which means inflation. Okay, but where's that inflation coming in? That inflation is not because of demand; it's because of supply. Energy is a supply side shock. Commodities are raw materials on the supply side. We're seeing these increase. That's what we call cost push inflation. That's what causes stagflation. So there is this huge risk of fertilizers also come from Russia and Ukraine, and so there's again a huge. In other words, what Anna's saying there, by the way, is that, well, why can't we just replace the wheat from Ukraine? So why can't we just replace it, plant it elsewhere? Well, the fertilizers come from Russia and Ukraine, so even that makes it almost an impossibility. The point is we're heading to a possible stagflationary environment. But gold is unsure if that is the case at the moment. Market participants are still unsure of that. That's why we've got this inside period, and that's why we've got a spinning top, and that's why we haven't quite made it to the upper quintile. So, given that the safe haven has perhaps an indecisive element to it, let's bring that analogy across to DAX. Okay, now let's look at DAX. DAX is not quite the same in terms of an inside period. What we do have with DAX is a lower high and a lower low. However, we do have a spinning top. Okay, so what we can say about DAX is that the bears have tried to push price down. The bulls have tried to push price up. Neither of them have had much success, and we're fairly flat from the market open, even though we've got this gap. Okay, so there is an element of indecisiveness in the DAX, just as there's an element of indecisiveness in the safe haven. And what that seems to suggest to me is that we're at a crossroads. Okay, and I think market participants are nervously waiting to see which path do we take. Do we go down the road of stagflation, and that would be an escalation in geopolitics, or do we somehow find our way to the diplomacy route and find that things de-escalate? Of course, that is supposition. but I think the markets are very much looking to see which area plays out. I would think that if the stagflationary environment materializes, we do get lower DAX. Okay, we do see a risk-off element that pervades. We're not quite there yet. Now, if we get the DAX moving into, I beg your pardon, if we get gold moving into the 80 area and we get DAX moving into the 20 area and holding, that's bad news. That's bear market technical signals right there. Now, let's just take a look at wheat, and let's just take a look at oil as well, just to include this in the analysis. So we'll start off with oil. I'm going to use Brent oil here as the proxy, and I'm going to bring wheat on this over here. And yeah, you can see wheat's gone limit up 2 days in a row. If I have to change this to the daily, okay, you can see how it looks like it may even go limit up today. All right, so the idea here is we're getting this huge surge of cost push inflation, huge. So let's now tie this into the Bitcoin chart that we looked into right at the beginning. We are overbought on oil. We are overbought on wheat. On any normal sort of given day, we would suggest that this is overdone. Unfortunately, the geopolitical risk that we're seeing is abnormal. It's not normal. And that means, you know, don't forget what happened to Bitcoin. For 6 months, Bitcoin remained, just going back to Bitcoin, for 6 months, Bitcoin remained overbought. But once it started correcting, it corrected hard. It corrected very hard. So just based on that, we want to monitor the, sorry, I want to bring up oil. We want to monitor this overbought condition. In my mind, it's overbought. It's run too hard, too fast. There is profit taking at the very least to be made, but the geopolitical escalation, the supply side shocks may just cause market participants to carry on pushing this overbought condition. So we want to watch this very, very carefully. The longer that we stay overbought on both oil, in terms of wheat, we can look at corn as well. Natural gas is not overbought at the moment, I don't think, but it certainly is. Do I have natural gas? Yeah, I do. It's not overbought, but it's turned up. Okay, so it's turned up. It's moving up. So we're getting these huge cost push pressures without the overbought conditions actually normalizing. So we're in desperate need of a technical correction here. The problem is we're in an abnormal environment, and I don't know how long we're going to spend in these excesses, but we're desperate to have some sort of correction. And the gold market knows that. Gold market knows that. That's why it's indecisive. Do we really need to put all our money into the safe haven? Isn't the market perhaps overbought? Shouldn't it correct? How long is this madness going to continue for? Surely one would think that there has to be peace talks sooner rather than later. But that, okay, is uncertainty. Because what happens if there isn't those peace talks? What happens if this continues? What happens if it escalates past the borders of Ukraine? I mean, these seem like such odd questions. Who would have asked these questions just a few months ago, right? The idea here is the gold market here is suggesting indecisiveness, uncertainty. That's very much reflected in the DAX, which brings us back to Anna's question. When are we going to be able to exploit the dip? And I think the answer to that, Anna, is not yet. okay, because we are still in this uncertain environment. Now we are in this. It just seems to be the theme of 2022. From the beginning of 2022, it seems that the webinars have been all about uncertainty. The problem with uncertainty is that is the very definition of market risk. And market risk is something that we need to be cognizant of. We have to put out the emphasis more on market risk than on the potential for exploiting any sort of price anomalies, and because the risk is too skewed at the moment. So we want to just keep monitoring this. We want to, of course, see some sort of de-escalation. I think as soon as there is some sort of de-escalation, there's going to be a huge bounce. But that's a big if. At the moment, it just seems that the Russians are hell-bent on causing utter destruction, and that is a terrible situation. Anna says she remembers the webinars during the pandemic plunge. Yeah. So let's keep monitoring this, guys. The takeaway from this is uncertainty. Is it a time to exploit the uncertainty? It might be, but I can't, with any sort of confidence, tell you, yeah, it's time to exploit. I can't do that. We're still in a very uncertain environment, and I think that uncertainty translates to risk, and we must acknowledge the high risk environment, continuing to hope and pray for a de-escalation here. All right, guys, if there's any questions, go ahead and type those in. All right, nothing coming in. I'm going to conclude at this point, guys. Join me tomorrow, and don't forget, we've got the live NFP trade tomorrow. Thanks very much for joining this morning. As always, highly appreciated.